Welcome to the SpreadX weekly financial trading preview. I'm joined with Analyst Connor Campbell, going to be casting his eye over what traders should be looking out for this week. So Connor, we're starting off looking at the FTSE.
Yeah, the FTSE's been in sort of a weird sort of limp trading bracket for I guess since the start of February, really, since the bloodbath you had in the first couple of weeks that month. It's then been trading since then between 7,100, 7,300. Every single time it's got to sort of the top of that range, investors have lost their bottle really, and it's pulled back. Sadly for the FTSE, really, there's nothing this week that could really help it out of that bracket. It's sort of been dictated by US sentiment for the last couple of weeks, and that looks set to continue in the second half of the week, just because there isn't enough for the FTSE to actually deal with UK wise for it to really be sent any higher. You've also sort of seen a change in its relationship with the pound. You know, throughout 2017, you had this really negative correlation between the two, that every time one was up, the other was down, and it was really well defined. And since 2018 it's begun, really that shifted, and every now and again you get these pockets of sort of animosity between the two. That isn't a guarantee anymore, which again makes it a bit more difficult for traders to work out what to do with the FTSE, because you haven't got the guaranteed direction between if the pound's down, the FTSE is going to be up, and vice versa. In terms of what there actually is for the FTSE to grapple with this week, I guess the highlight is going to be Wednesday's Chinese industrial production figures, because that may have a bearing on the FTSE's sort of quite a significant chunk of mining stocks. I think the figure is expected to rise from 6.2% to 6.3%, so that could be a bit of good news for the miners, and could see the FTSE bounce at least maybe towards 7,250. But again, like I said, the index might end up just finding itself being dictated by US trading, which, as we've seen in the last couple of weeks, is fairly temperamental and doesn't necessarily. It can sort of cause some fairly big movements, but it doesn't necessarily cause stable movements that are actually then maintained until the end of the day. You see these fairly big swings throughout the day, and then by closing time, the FTSE ends up being around back where it was.
More intraday trading, perhaps. Okay, well, we'll look now at some stocks in focus this week. And the first one, we look at Morrisons.
Yeah, Morrisons, it was really had a very strong turnaround under David Potts. It was in dire straits a few years ago, but now it's consistently posting sort of not only just quarterly like-for-like growth, but fairly substantial quarterly like-for-like growth around the 2.5% to 3% mark, which, given the difficulties of the UK supermarket sector at the moment, any like-for-like growth at all is impressive, let alone getting towards that 3% mark. I think back in November it disappointed investors slightly. I think like-for-like growth came in at 2.5%. That was down on the 2.8% forecast and the 3% it had seen at the half-year mark. But then again, in January, back up to 2.8%. For the sort of the pre-Christmas period. Sorry, I think it had its best premium line was up 25% sales-wise. Online sales were up 10%. Really healthy figures. However, like all the supermarkets, it's dealing with costing price pressures, then the threat of Aldi and Lidl. And I'd say out of all of the big four supermarkets, Morrisons is at most risk from Aldi and Lidl. It's sort of the bottom tier of the big four. And every time it needs to cut prices, or it feels like it's forced to raise prices a bit because of the costing price pressures, it's going to lose another set of customers to Aldi and Lidl. In terms of what it's going to release on Wednesday, it's its full year figures on Wednesday. I think investors are going to be looking for like-for-like growth to come in around the 2.8% mark. That's roughly the average for the year in total. So anything a bit above that, I think, will please investors. In terms of what our clients are doing, at least, they've begun to sell around £2.25. I think it's sort of the company's bounced in the last few weeks, and I think they're looking for perhaps, if not disappointment figures-wise, then another sort of tough outlook for the year ahead. It's a difficult sector to be in the moment. Things aren't getting any easier. Inflation's fairly persistent around those 3% levels for the UK in general. I think that's perhaps what our clients are looking for, some kind of negative guidance on Wednesday that might drag the stock back a bit lower.
Okay, interesting. Next up, Dignity.
I honestly can't think of a stock that must have had a worse 2018 than Dignity. I think it fell 49% in a single session. I think it was on the 19th of January, and that was already down quite sharply from last November. So I think at the moment it's trading around £8.75. At the start of 2017 it was trading at £24, which that's an astonishing drop. However, it has led to sort of wave upon wave of SpreadX clients now buying the stock around the £8.75 levels, and maybe towards £8.50 as well. I think just because of how dramatic that drop has been in 2018 specifically, I think investors are now perhaps fishing around for the lows and thinking, is it time that the stock bounces? In terms of its full year figures on Wednesday, I think investors are going to see. I think it's it's been posting around a 6 to 7% rise in revenue across the half year and the third quarter, so I think they're going to be looking for maintaining those figures. Ditto underlying operating profit, I think is expected to rise 5 to 7%. So figures around then may help distract from some sort of the strategy shift it announced in January. So I think it announced some fairly significant changes to its pricing structures. I think now it's sort of simple funeral, so the most basic offering it has. I think in the UK and Scotland that's going to be 26% cheaper to £1,995. In Scotland it's going to be down 37% to I think £1,695. That's some serious reductions in price. That takes it level to the Co-op in terms of the Co-op is its main rival for funeral services. Those kind of pricing structures now take it level with the Co-op. But I think Numis Securities analyst there said that's going to cost it £50 million in 2018 earnings-wise. So that's a pretty hefty drop. So the company does have a lot it needs to alleviate really with its full year figures on Wednesday, and it'll be interesting to see how much, whatever the positive growth in revenue and underlying operating profit, how much investors focus on that rather than the guidance for 2018. But like I said, our clients at least seem to be willing to take a risk on Dignity at the moment just because of how drastic the drop has been in 2018, and like I said, buying around the £875 mark.
Okay. And then finally, Wetherspoons.
Yeah, Wetherspoons had an incredible 2017 with you. I was a bit surprised when I looked. I think they were up 40% on the year. The bulk of that growth coming in September, because I think it announced operating profit was up 26%, like-for-like revenue was up 4.3%. And that strong performance has only continued into the first half of its 2018. I think it said that for that 6-month period, like-for-like sales were up 6%. I think that compares to a 1% rise for the wider pub sector. So it's really, really ahead of the curve there. I think total sales were up 4.3%. Again, very, very strong. However, it marred that slightly by saying that it'd be a lot tougher to match that really strong performance in the second half of the year. So I think on Friday, this is half-year figures on Friday, I think the reaction is really going to be dependent on the guidance it gives for the second half of the year rather than the figures it posts for the first half of the year. Purely because if it is going to be difficult to match that kind of growth, investors are going to want to know, what kind of slowdown are we seeing? If it's still posting around the 5%, 4% like-for-like sales growth, I think investors might take that given just the wider sort of consumer issues in the UK at the moment. Anything larger, however, might be a cause for concern. Complicating matters is the fact that Wetherspoons is trading roughly at all-time highs, which adds an element of risk, and perhaps what investors' expectations on Friday are going to be a bit different if it hadn't climbed so sharply in the last couple of months. From our clients' perspective, they're still buying around the £13 mark, which is roughly Wetherspoons' all-time highs, but it shows that they're sort of confident in the company going forwards. It's weathered enough sort of stormy periods in the past. There's no reason why it can't do that in the future. However, there is that risk attached of any company that's trading at all-time highs heading into a potentially weaker second half of the year could see like an over-exaggerated pullback if the figures don't meet investors' expectations on Friday.
Okay, interesting. Connor, thank you very much. That's all for now.